Talking today about perspective on mortgage rates. Obviously, some volatility recently with what mortgage rates have done. So, just wanted to spend a little bit of time, provide some perspective on that, and maybe give some thoughts on kind of what the future might look like as well. I'll start with just basically showing what the 10-year Treasury has done since February 28th, when the conflict or war with Iran began. So I pulled just a little screenshot here, and it shows you from that Monday the 2nd, when the markets opened up to present, and you can see big uptrend on 10-year Treasury yields, which unfortunately that's a bad thing for mortgage rates. So really, since this thing began, you can see some positive rate movement in there as well. As the 10-year Treasury yield goes up, pretty much in lockstep, mortgage rates will go up as well. So once again, since that Monday the 2nd, after the Iran stuff began to present, you can see mortgage rates up from 6% to right at about 6.5%. So, in a few weeks' time, not even a month's time, pretty significant move in interest rates. Not great news for the market here presently as we move into the spring months. However, I'll kind of give some perspective here a little bit later on what I think the future holds. But one question that we've gotten a lot of times when there are things globally, politically going on, such as war, sometimes that can work in the favor of interest rates. And I've had a lot of customers ask, hey, with all this uncertainty going on, I would expect interest rates to go down, not up. Why is it going the opposite direction? Typically, rates can decline during something like what's going on right now, because when there's uncertainty in the market, a lot of times investors take their money out of the stock market, they move it into the bond market, which then in turn helps interest rates. And also sometimes that can be piggybacked with concerns about economic slowdowns. Market begins to price in a weaker economy. That generally helps interest rates as well. And then lastly, when you have things like what's going on right now, Fed policy is more accommodative. So they might be less likely to hike interest rates. They might be more likely to cut interest rates to help to accelerate the economic growth, with all of the other variables considered. So those are the things that, generally speaking, in the past, maybe you would see something like this and the mortgage rates would come down. However, obviously, from what I showed you before, that's not what's happened. And really, the biggest reason why mortgage rates have gone up this go around is pretty simple. Oil prices are going up considerably based on who the conflict is with and where they are in the world. Unlike previous conflicts, this one has really directly had an impact on oil prices. So oil prices have gone from, $60 a barrel to $100 a barrel, which the concern there is all of the different things that are impacted by rising oil prices. So you look at inflation, how inflation is determined, prices going up, so many things are funneled through the cost of energy, right? And oil being the largest use of energy. So that's really the concern. And more specifically, Iran has control over the Strait of Hormuz, which about a fifth of the global oil supply goes through that passageway. So I'm sure you guys have seen the news, what's going on there. But the reason that interest rates have gone up so sharply, there are other kind of little ancillary reasons, but the biggest one is really concern of oil prices, concern about inflation, concern about Fed policy moving forward based on how they're going to respond to that. So all of those things have caused the markets to now kind of price in more volatility. As far as what's going on right now, it's kind of an interesting dynamic, because if you zoom out a little bit, we've got pretty much the epitome of a push-pull dynamic going on right now with inflation, rising oil prices, inflation concerns. We talked about that, and that would tend to lead to higher rates, right, if there are inflation concerns. And this is really a supply shock. It's not a demand situation. So you could also argue that the Fed hiking interest rates is not really going to do anything to that, because you have a supply issue. You don't have a demand issue where there's too much demand that would drive prices up. However, you would also then have to assume that the Fed would see this as kind of a isolated event and not base monetary policy around that, which we're not Fed members, so we don't know what they're going to do. But on the flip side of that, you've got those concerns. But then on the flip side, you've got the concerns of weakening job market, and the unemployment rate's still in a decent spot right now. But the reality is the job numbers over considerably last 3 to 6 months have been noticeably weaker. So you've got softening job growth. You've also got softening economic growth in a lot of areas. So on the other end of that would argue for lower rates. So you've got this kind of push-pull dynamic with what's going on right now between inflation and how that impacts things and economic weakness. Do the Feds have the bandwidth to even be able to hike interest rates if they wanted to? I would probably argue no, based on where the job market is. But that's kind of the push-pull dynamic, and really that has the Fed on pause right now. And prior to when all of this started, if you go to the poly markets, that gives you the odds of what's going to happen with Fed policy, amongst many other things you can look at on the poly markets. But I looked at this morning, and pre-Iran conflict, the overwhelming consensus was 2 rate cuts this year. Secondarily was 3 rate cuts in some scenarios. As far as the betting odds for how many rate cuts will happen this year, if you look at the present snapshot in time, the markets are pricing in no rate cuts this year as the most prominent scenario. So the markets are now saying, hey, and it's not a wide difference, but they're basically pricing in now, hey, no rate cuts is the likely outcome, and then 1 rate cut is secondary to that. It tells you how quickly the markets can change their mind with unforeseen events, right? This is not something that somebody could put into a forecast, but just interesting to see how quickly the markets reverse course on what they think is going to happen. But in terms of the cost of waiting for certainty, and in terms of practical use of how you can use some of the information that I just gave you here, especially with what I showed you a moment ago with mortgage rates and what I'll show you in a minute with kind of zooming out a little bit on mortgage rates. When things like this happen and there's uncertainty and there's volatility, there's a subset of people that want to wait for clear direction, right? They don't want to re-enter the housing market until they're certain that interest rates are coming down. And sometimes that uncertainty, they may miss an opportunity, right? You can't always start at, I'm going to wait for the thing to happen before I do anything, because as I'll show you here in a moment, there are these ebb and flows with interest rates where they'll come down considerably, they'll go back up considerably. Really difficult to time what's going to happen with interest rates because there's so many factors that are outside of control of anybody to know what's going to happen there. So in terms of talking with clients, we're doing more of a therapy session with a lot of customers these days. But when people call and maybe they've been looking for a while and rates are higher, or maybe they call us and they just make mention of the fact that rates are higher, I think that within that conversation, you say, hey, listen, the people that are already approved, poised, and ready to act when things improve, or if things improve, are going to find themselves in a lot better position than people that are waiting for things to improve before they begin, because you don't go from, I'm interested in buying a house, to I've spoken to a lender, to I've pre-approved, to I found a house and now I'm under contract. That doesn't happen in a day's time, right? Maybe every once in a while it does, but that could be something that takes weeks or months. So if you're starting from, I'm not going to do anything until I see the rate that I like, the rate may not be here very long because there is a lot of ebb and flow in the current state of things with what interest rates are doing. So buyers that are already approved, they know what's going on, they have somebody that's keeping them informed on what's going on with interest rates. Those are the people that can create a true strategy around what a good opportunity might be for them to buy. And that's really the biggest takeaway in what's been a very troublesome, challenging month, right? The month of March has not been great from an interest rate perspective. And I think silver lining there is the opportunity to really speak to customers about how to make sure they're there to take advantage. But perspective on mortgage rates, the other thing I reminded myself of a week ago as all this was kind of going on is I looked at what were rates this time last year relative to what they are right now. So this is from March 26th of 25 to March 26th of 26. And you'll see that interest rates are actually lower now than they were last spring. And last spring for a lot of people was fairly good. You know, I think as far as context goes, a nice reminder to people is, hey, interest rates are lower today than they were a year ago. I also then zoomed out 2 years, right? And looked over the past 2 years. And other than this little dip right here in September of 2024, for the most part, rates have been higher over the last 2 years than they are presently. And then I went back one more time and said, okay, well, let's look at 3 years. And once again, you look over the course of a 3-year view here, and for the most part, rates have been higher, sometimes by a good margin, than they are right now. But also within that, this chart is somewhat zoomed out. So these fluctuations are maybe not as significant as if we were looking at a shorter time horizon. But you look at all of these things where rates go up, they sharply come down, right? Rates go up, sharply come down. Rates go up, sharply down, right? Rinse and repeat all the way down. This is a nice little steady line here. But the point of that being, with what we're in right now, there's a likely chance that at some point this gets resolved and rates sharply come down, right? So if you're a buyer looking to take advantage, you probably want to get pre-approved somewhere on this side of the equation so that you are buying somewhere on this side of the equation instead of waiting for this and then you find the home and now you're here, right? So I think having this kind of information is super valuable to share with people in times of uncertainty, because that's a lot of times where the opportunity presents itself. The other thing I'll show you, and why I think that if we zoom out a little bit, I would say, yes, if this conflict continues to go on for many months, rates certainly could go higher. There's a scenario where rates could go higher than they are right now. But I think on the flip side of that, even since this time last year, we have 3 more rate cuts that have come through the system. And what that has done is it has improved the spreads between 30-year mortgage rates and 10-year treasuries. So just to explain what that means, the 10-year treasury generally is a very close correlation to what a 30-year mortgage rate is going to do, meaning if the 10-year treasury yields are going up, generally mortgage rates are also going up. But in times of extreme volatility, such as 23 and 2024, basically the markets were pricing in a lot more uncertainty and risk. And the result of that was the difference between what the 10-year treasury yield was and what mortgage rates were was very much elevated relative to historically how they follow one another. So over time, generally, just to use round numbers, if the 10-year treasury yield is 4%, you would generally expect mortgage rates to be somewhere between 5.75% and 6%. That's usually the spread on average between what the 10-year yield is and what the 30-year mortgage rate is. If you look at 2024, sometimes that was almost 3% higher. So today's 10-year treasury yield would yield mortgage rates, if the spreads were similar, somewhere in the mid sevens. We're nowhere close to that. We're in the mid sixes, right? So that is the difference in the spreads. If you look at 2025, they got better. They're still elevated, but all the way down to towards the end of the year, similar to where we are now, the spread right now is about a 2% difference, which has moved back into normal range. So the spreads, with all of the rate cuts that have happened, that have come through the system, that has helped to kind of regulate interest rates. And quite frankly, if we were dealing with 2024 or 2025 mortgage spreads, the mortgage rates would be a lot worse than they are right now. So that is one thing that's going to help to keep a lid a little bit on how high interest rates go as this all works to a resolution. And last thing I'll say, outlook on rates. I would say, once again, the duration of how long this goes will ultimately tell the story. But I think that the reality is we see how quickly things can change. And if this is resolved in a short time frame, you could see a rally lower in interest rates. We could be having a completely different conversation in 2 or 3 weeks. And the poly markets could change, and now they're pricing back in a rate cut, or maybe they're pricing in 2 rate cuts. So these things can change so quickly that it's almost worthless to put a lot of time in forecasting, right? I think it's more so a matter of staying up on what's happened historically. When I show you these rate charts, the big spikes and lower movements in mortgage rates, and buyers understanding, hey, get your pre-approval, get your things in order, understand what's going on, stay informed, have your lender keeping you posted on what's going on with rates. Obviously, even as real estate agents, you guys can do that as well. But trying to find the opportunity in the market. And then the last little thing that I'll say is, in times where interest rates have gone up, it's just another opportunity us to be able to remind people that when they negotiate on price of a home, they can negotiate not just price, but also they can negotiate down to a lower rate. So what do I mean by that? I'll give you a quick example. This is a loan that we closed last month. It was a real life scenario. The list price was $335. Buyer was going to go in at $329, or they were going to go in at $309. So they were going to come in $26,000 off list price. And the numbers were tight. Debt to income ratio was tight. And I said, hey, why don't we look at this a different way? What if we go in at $329? You get 6%, which is basically 20 grand. We use that money to buy down the interest rate. So I showed them both scenarios. You can see them side by side here. This was the current interest rate at the time on this loan they were using. And then this was the rate if they bought it down. So the payment ended up being about $115 lower a month. Cash to close was similar. And ultimately, that's about a 10% reduction in 5 to 6% reduction in mortgage payment, right? So $115 made the difference between qualifying and not qualifying, and also made them feel a lot more comfortable. And lastly, it puts them in a interest rate where unlikely to be refinancing out of this interest rate, right? So now they've also eliminated the variable of waiting for interest rates to change so they can refinance. I think that a lot of people negotiate, or they think of a deal as, I'm trying to negotiate the price down, right? The reality is most people call us for a loan and they say, hey, I want my payment to be no more than this. So they're shopping for a payment, although they're shopping for a home and they're paying a price for that home. They're really shopping for a mortgage payment of what they want to spend every month. If we keep that in mind, there are ways we can hopefully creatively structure offers where even in times of elevated interest rates, maybe there's more negotiating opportunity and buyers can still come out with a scenario that maybe would be a lot more favorable than if they wait for rates to come down and more buyers enter the market and then prices go up or the amount of demand goes up as well. So that's not to say that every single property we're going to get a 6% seller credit. Please don't take this to me that I'm advocating for everyone to get 6%. But I think it's just a good reminder that if you negotiate the rate down, that may be a better scenario at the end of the day. I know it was a lot of information there, but I know I mentioned that we were going to speak briefly about the recent condo related changes that came out this week, but I'll just give you the short and skinny. So Fannie Mae and Freddie Mac, both following the same policy, a release on March 18th regarding changes primarily to condos, a couple other changes in there as well. But obviously, condos have had a lot of lending related changes over the course of the last few years due to some issues, condo building collapse in Miami. That kind of led to rethinking, do the requirements for deferred maintenance need to improve? And that kind of led down a rabbit hole. But as far as the highlights of the changes, so the big changes here are first and foremost, Fannie Mae and Freddie Mac used to allow for something called a limited review. And that meant if you were putting enough money down, 25% on a primary residence, 30% on a second or investment home, basically there was less information that needed to be verified to approve the condo for a loan. Not something that, with some of the changes, the limited review process was not as beneficial as it used to be, but essentially they're sunsetting that. So every condo will have to go through a full review process. For perspective, that's probably only about 10 to 20% of the condo sales that were happening that were limited reviews. So we're not talking about a large pool of transactions that were limited reviews from a financing standpoint. So it's not a tremendous change, but it is something that I would say is maybe more bad than good because we don't have that opportunity to do a limited review. The second thing is no matter if you're buying a primary, secondary, or investment property, it no longer matters what percentage of the total units in the condo project are investor owned. So it could be 10% investor owned, it could be 90% investor owned. That no longer matters. So that's a positive change. And as far as the other highlights that really would be something that you guys would be impacted by on a day-to-day basis, the biggest change here is typically, for as many years as I've been doing this, condos have to carry 10% in replacement reserves as part of their budget. So for those of you that aren't familiar, what that means is the condo has to have 10% of their total annual budget set aside for reserves, for capital expenditures or deferred maintenance or other items. And that number is being moved from 10 to 15% effective January 4th of next year. So that's a pretty big deal. If I had to guess, this is just my immediate thought. If I had to guess, I would say there will probably be enough pushback and lobbying from people in the industry that if nothing else, that timeline may be getting pushed back in terms of going from January of 27 to maybe somewhere farther down the road. Because when you're talking about increasing reserves on a condo from 10 to 15% for an entire condo project, you could be talking about millions of dollars to make that happen. And generally for these associations that have budgeted everything around 10%, to go from 10 to 15 is going to require increases in HOA dues, possibly special assessments. So that's a big deal. I mean, certainly having 15% in budgeted reserves makes for more sound condos for future property values and future owners, right? But the process of getting there would be likely relatively expensive for a lot of condos that have budgeted for 10%. So if I had to guess, I think the date probably gets pushed back on that. But if it doesn't, that just adds a layer of difficulty to condo lending because for so many years, these associations have budgeted for a 10% reserve requirement. And there are little nuances within that. You can get reserve studies that are done by the association that say this is the actual amount of reserves that we need. So there's some ebb and flow there, but by and large, that's something that's a challenge for condo lending. It's not necessarily a positive today, if that makes sense. But the big thing that I would say the biggest win that came out of this is for those of you that have been here for a little while, homeowners insurance costs in Florida have gone up over the course of the last 3 or 4 years, maybe a little bit longer than that. But one thing that's been a challenge for condos is in an effort to cut costs, many condo associations have been rewriting their insurance policies to get a cheaper policy. And the easiest way to do that for a lot of them was to change their replacement type coverage on the roof for all of the buildings, the roofs, from replacement cost to actual cash value. What that means is that the roofs need to be replaced. Historically, it needs to be insured at replacement cost, meaning that the full cost of the roof is covered by the insurance policy, as opposed to actual cash value, which means you will get from the insurance company what the roof is worth at that time based on the remaining economic life. Moving forward, roofs can be insured at actual cash value, not replacement cost. And if you've done any condo transactions at all, I can guarantee you that probably for the last year or two, one of the biggest things that was stopping condo closings from happening was this very issue. So that's a very positive thing for condos moving forward, that we can accept the roof being insured at actual cash value, not replacement cost. So that's a big win. That's the biggest win that came out of this. And then lastly, that same guideline actually applies to just general homeowners insurance policies. So once again, for somebody buying a single family home, we also had to show roof was insured at replacement cost, which oftentimes led for more expensive policies. If it's an older roof, maybe they couldn't get insurance coverage at replacement cost. Maybe they could only get an actual cash value policy. So once again, that's another win for being able to get loans done and being able to keep insurance costs down, to have something insured at actual cash value, not replacement cost. So there are a couple other nuances within those changes. Realistically, they're probably not things that you would encounter very frequently, but those are the highlights there as far as the limited reviews, the investor concentration, the reserve increase, and then also the insurance requirements we just talked about.